Welcome back to the deep dive. Today, we are taking you straight into the cold, strategic efficiency of the Nordic industrial sector.
We're going to examine a very particular business model that is, frankly, baffling markets right now with its resilience and its valuation.
It's remarkably high valuation, yeah. We're focused entirely on Momentum Group AB. It's a Swedish industrial distribution company that has, well, it seems they've fundamentally mastered the art of being a serial acquirer.
That's right. And our mission today is very specific. We need to pull apart the decentralized strategy of this, what they call the buy and develop compounder model.
And figure out how it works.
Exactly. How does it manage to not just survive, but actively thrive under what is pretty severe economic pressure right now?
Right, because Momentum Group just dropped their Q3 2025 results, and they delivered record profits and, a solid 7% year-over-year growth in their main profitability metric, which is EBITDA.
And 7% growth in this environment, I mean, that sounds fantastic on its own, especially for industrial distribution, which is usually tied very closely to the economic cycle.
It is, but here's the central paradox, and this is really what we need to crack today. Momentum Group achieved that 7% growth while it's organic sales.
So sales from the businesses they already owned a year ago.
Exactly. Those sales were actively shrinking. That organic decline hit a pretty significant minus 4.0% in that last quarter.
So how do you do that? How do you grow profits and maintain this premium valuation when your day-to-day operations are technically contracting? That's the puzzle we need to solve.
It is. We are looking at the pure archetype of the buy and develop compounder. It's a model that's, very common across Scandinavia.
And we should be clear about what that means. This is not traditional private equity. PE buys a company, and they have a clock ticking.
A 5-year timeline, usually.
A strict 5-year timeline to flip it. These companies, like Momentum, they buy to hold. They are permanent owners, and their whole model is about continually developing the assets they acquire.
And the market loves this model. Absolutely loves it. It assigns these compounders a huge, sometimes dizzying premium valuation.
It does.
So our job is to figure out why Momentum Group has earned its spot in that premium bracket, even with some serious operational headwinds dragging on its core business. We have to understand the specific engineering behind its resilience. Okay, let's start at the beginning. Let's establish who Momentum Group is, beyond just this serial acquirer label.
Right. They're a Nordic industrial group. They were spun off from another company, Alligo AB, back in 2022, and they're listed on the Nasdaq in Stockholm.
But the key thing for you to understand right away is its structure. This is not a centralized industrial, like, say, a Siemens.
Not at all. It's really a holding company. It consists of over 30 independent subsidiaries.
30-plus companies.
30-plus. And those subsidiaries are the absolute heart of this buy and develop system. This gets us straight to their foundational principle, what they call decentralized ownership.
And they really lean into this idea of being a permanent owner.
Oh, heavily. It's not just marketing speak. It is their core differentiator from private equity. When a business owner sells their company to Momentum, they're basically guaranteed a stable, long-term legacy for their company, their brand, their people.
That concept has to be incredibly powerful, especially when you're targeting the exact kinds of companies they are. These are small, often multi-generational, family-owned niche distributors. That's their M&A fuel.
It's a perfect pitch for that seller. But you've hit on the big challenge right there.
Which is what?
How do you manage 30, maybe 40 or 50 someday, diverse businesses scattered across different niches and countries without, eventually centralizing everything?
And suffocating that entrepreneurial spark that you paid for in the first place.
That is the crucial operational tightrope they have to walk. And it really defines the success or failure of this entire model.
So how do they do it?
They grant the subsidiaries a very, very high degree of entrepreneurial freedom. The local CEO, the management team, they are free to make almost all the key decisions.
Like what kind of decisions?
Local strategy, inventory procurement, which brands to stock, who their key customers are, customer service. I mean, they are the experts in their specific niche, right? The group doesn't pretend to know better. They don't interfere.
Okay, but if they have all this freedom, what stops them from just drifting off course or running inefficiently or, chasing some vanity project? Where's the accountability?
And that's the other side of the coin. That autonomy is strictly, and I mean strictly, balanced by responsibility.
Responsibility to what?
The responsibility is defined by the group's rigorous group-wide financial targets. This is the concept we call governance by numbers.
Governance by numbers. So the head office in Stockholm isn't telling them what to sell,
No.
but they are dictating exactly how capital efficient and profitable they have to be.
That's it. It's basically a pure performance contract. The local managers get to keep their operational freedom, their autonomy, but if they miss the financial targets,
And then freedom probably evaporates pretty quickly.
it does. The group steps in. And this financial alignment mechanism, this is the true secret sauce. It ensures that those 30-plus separate companies are all laser-focused on the exact same two goals.
Profitability.
Profitability, measured by EBITDA margin, and maybe even more importantly, extreme cash flow generation. And they get that through efficient working capital management.
And these aligned companies then feed the two big engines of value creation for the whole Momentum Group.
Right. Engine number one is the obvious one, acquisitive growth. They systematically, consistently go out and acquire profitable, niche companies.
And engine number two.
Engine number two is often overlooked, but it is just as vital for justifying that long-term premium valuation. It's organic growth and development.
So this is how they professionalize the companies they buy.
Exactly. They don't just consolidate back-office functions like accounting. They actively strengthen the existing companies by giving them group resources and expertise that a small, family-owned firm just wouldn't have had access to before.
Can you give us a concrete example of that? I mean, what kind of resources are we talking about?
They run these formalized internal development programs. They're designed to standardize best practices, but without killing the local culture.
Okay.
The sources specifically mention a business school and a sales school.
A business school.
Yeah. The business school might focus on, say, optimizing procurement, teaching advanced inventory management techniques, or improving the consistency of internal financial reporting. It's about operational excellence.
And the sales school.
The sales school would make sure that the subsidiary managers are leveraging data and modern digital tools to maximize their sales effectiveness, moving them away from just relying on old personal relationships alone.
So they are effectively exporting institutional knowledge across the whole portfolio to boost margins after they've made the acquisition.
That's the idea. They're buying the niche expertise and then combining it with standardized operational excellence.
That makes a lot of sense. Okay, let's quickly break down the structure of what they actually sell. The group is split into two main segments, industry and infrastructure.
Right. The industry segment is let's call it the traditional heavy hitter. It's pulling in around 1.77 billion Swedish kroner in the last rolling 12 months.
And what's in there?
About 75% of that segment's revenue comes from power transmission. So for you, think about highly critical but somewhat commoditized components. Bearings, seals, gearboxes, industrial tools.
And this is overwhelmingly focused on MRO, right? Maintenance, repair, and operations.
Overwhelmingly. The rest of that segment is in more specialist niches like hydraulics and automation components, and they serve both MRO and, to a small extent, original equipment manufacturers, or OEMs.
And then there's the infrastructure segment. It's a bit smaller at 1.36 billion in revenue, but it seems to be the rising star. It has better growth characteristics.
That segment is absolutely critical to the future story here. It's primarily split into two areas: flow technology and technical solutions.
Flow technology. What does that cover?
It's over 60% of that segment. It deals with critical process solutions, so things like specialized valves, pumps, couplings, all necessary for complex social infrastructure.
So not just any factory. We're talking about
Think heat production plants, water treatment facilities, district heating systems, big, essential long-life assets. Then the technical solutions part focuses on the repair, monitoring, and efficiency services for those assets to maximize their functional lifespan.
So the industry segment is sort of the reliable operational base, and infrastructure is the engine that's connected to these bigger future structural themes.
That's a good way to put it. But regardless of the segment, the foundational resilience for the whole group comes from the customer mix. We really need to zoom in on that critical aftermarket exposure.
This is a huge point.
It is non-negotiable for understanding why the market gives them that premium valuation. The source data shows that approximately 90% of Momentum Group's revenue comes from the aftermarket.
Yeah.
So MRO and also RMI renovation, maintenance, and improvement.
And only about 10% comes from OEMs, the companies that are building brand new machinery or capital equipment.
Only 10%.
Okay, let's spell out why that 90% MRO number is so potent, especially during an economic slowdown like the one they faced in 2025.
MRO revenue is fundamentally tied to the existing installed base of industrial and infrastructure assets. So here's an example for you.
Okay.
Imagine a regional manufacturing plant. When the economy starts to slump, the CEO's first instruction is to cut capital expenditures. Cut CapEx.
Right. They immediately postpone buying that new, shiny, efficient assembly line they planned for next year.
Exactly. And that immediately cuts off demand for the OEM suppliers. That's the 10% of Momentum's business that gets hit.
But the machinery they already have on the factory floor still needs to function.
It absolutely has to.
Yeah.
The existing 5-year-old compressor still has bearings wearing out. The industrial boiler still needs a specialized valve replaced, and it needs it replaced immediately, or the entire plant has to shut down.
So that spending, the MRO spending, is non-discretionary.
It is necessity-driven spending, just to keep the lights on and maintain regulatory compliance. It's a cost of doing business. It's not an optional investment. And that 90% exposure creates this profound cyclical buffer. It insulates MRO-focused companies like Momentum Group from the absolute worst of the economic storms.
And that allows them to manage their cash flow with much greater stability than their peers who are more exposed to that cyclical CapEx spending.
That's it. So the blueprint is clear, right? It's decentralized efficiency that's managed by the numbers, it's powered by a steady M&A pipeline, and the whole thing is structurally protected by that 90% MRO exposure. That is a clear framework for long-term compounding. So now that we understand the internal mechanics, let's look at the external environment. They're operating in the Nordic industrial distribution sector. It's massive, it's mature, it's stable, valued at over 130 billion US dollars.
Wow.
It's broadly correlated with GDP, but again, as we just discussed, it's significantly buffered by that high RMI and MRO demand.
Okay, so stability is the foundation. But what are the deep, multi-decade structural drivers that are actively reshaping this massive market? This is where the long-term growth story really has to come from.
And the single most significant driver mentioned in all the sources is the green transition.
Right.
This is a generational investment theme, not just in the Nordics, but across the entire EU. It means there is massive, sustained investment required in green infrastructure, in energy-efficient renovations, grid electrification.
Expanding renewables.
Expanding renewables, yeah. Large-scale heat pump installations, all of it.
And this transition isn't just a rising tide that lifts all boats. It specifically funnels demand directly into their growing infrastructure segment.
It creates this powerful non-cyclical demand. I mean, for example, their flow technology division sells critical components that are essential for maximizing the efficiency of district heating networks, or for modernizing outdated fossil fuel power plants into cleaner operations.
Or just managing the grid.
Or managing the increasing complexity of the grid infrastructure that's required to handle intermittent renewable energy sources like wind and solar. This driver is so strong, it actually transcends the current temporary economic slowdown. It gives that infrastructure segment a built-in structural tailwind.
Okay, so beyond the green movement, what are the other forces that are changing how industrial customers actually buy their parts?
We're seeing two fundamental dynamics playing out. First is supplier consolidation, and the second is the necessity of digital disruption.
Let's unpack supplier consolidation first.
Historically, an industrial customer, like a big factory, might have dealt with dozens of hyperlocal specialized distributors, one for bearings, one for hydraulics, another for safety gear.
Right.
Today, they are actively pursuing supply chain simplification. They're deliberately reducing their supplier lists. They're moving away from having 50 vendors down to maybe 5 or 10 strategic partners.
They're preferring the large, technically proficient one-stop shops.
Precisely. The customers want a distributor who can offer a broader range of specialized products, technical services, and consistent, reliable logistics. It's much easier than dealing with dozens of small local shops, each requiring a separate account, a separate procurement process.
And Momentum, by aggregating its 30-plus niche companies, it basically transforms from a collection of small players into that one preferred, large, proficient supplier.
That's the goal. And digitalization is just accelerating this whole trend.
In what way?
It's becoming an existential threat to the status quo. The sources highlight that B2B e-commerce penetration in the Nordics is already significant. It accounts for 28% of sales, and it's growing fast.
So the old model.
The old model of salespeople, phone calls, paper catalogs is rapidly being replaced by sophisticated online ordering, real-time inventory checks, and complex data analytics platforms.
So if you're one of those small family-owned distributors failing to invest heavily in sophisticated logistics, warehousing, and a best-in-class digital platform is no longer just a missed opportunity. The sources say it's an existential risk.
Absolutely. If a small player cannot provide the necessary digital convenience, You know, inventory visible 24/7, seamless ordering, efficient delivery tracking. They simply cannot compete anymore with the large players who have the capital to build out these systems.
And this brings us right back to the market structure.
It does.
And that market structure is defined by what the source calls extreme fragmentation.
Exactly. We're talking about thousands of small, independent, often family-owned niche distributors scattered across the region. They typically have great customer relationships, deep local technical knowledge,
But they lack scale. They lack capital.
and they lack the digital expertise required to meet the demands of modern and desperate procurement.
So that fragmentation, that is the critical raw material for the whole serial acquirer model.
It creates a massive, deep pool of acquisition targets. It's why consolidation in this industry is rampant. It's pursued not only by generalist strategic distributors, but by these specialized buy-and-build compounders like Momentum Group, but also Lagerkrantz and Indutrade.
They have a structural advantage because the supply of targets is, for now, virtually limitless.
It seems to be.
Okay, let's talk about how Momentum wins, how they win customers, and how they win acquisitions in this fiercely competitive environment. They state explicitly that they compete on value rather than price.
Which means they need competitive moats that go beyond just being big.
Right.
And they really rely on two fundamental moats. The first is what we can call the technical moat.
What does that mean in practice?
It means aggregating that deep, specialized technical knowledge from across all 30-plus subsidiaries. In areas ranging from precision hydraulics to complex flow technology, this allows them to offer comprehensive problem-solving solutions that a generalist distributor just cannot match.
Can you kind of illustrate the difference for us? A generalist versus Momentum's specialist approach?
Sure, a generalist distributor might sell you a replacement bearing at the best possible price.
Yeah.
That's a transaction. Momentum, through its specialized subsidiary, is not just selling you the part. They are diagnosing why that bearing failed prematurely in the first place.
Okay.
Perhaps they identify a misalignment in the gearbox or a faulty seal, and they offer a systemic solution to prevent future downtime. They're selling reliability, not just components.
And that expertise translates into massive customer switching costs. Because you're not just switching suppliers at that point, you're replacing a trusted technical advisor.
That's the moat. But the second moat is perhaps even more critical for sustaining their growth engine, and that is the M&A cultural moat.
This sounds proprietary.
It is their proprietary advantage in the acquisition process. That permanent owner and decentralized model we talked about is profoundly appealing to the founder owners of those family-run businesses.
Because these founders typically care deeply about their legacy, right?
Oh, yeah.
Their local brand recognition, the welfare of their employees.
They do, and they fear the alternatives. Selling to private equity means guaranteed cost stripping, eventual restructuring, and a forced sale in 5 years.
And selling to a big strategic competitor probably means the local brand and the culture are erased entirely. They just get absorbed.
Exactly. So Momentum's pitch is highly, highly effective. They can say, we will pay you a fair price, we will keep your brand and your employees intact, and we will keep you running the business, but now with better centralized resources.
And that cultural fit often means that Momentum is the preferred buyer, even if their price is, say, marginally lower than what a PE firm might offer.
Which ensures a robust and high-quality inflow of M&A opportunities, often at more attractive valuations. The assumption is around 6 to 8 times EBITDA than their public market peers are trading at.
So the cultural moat feeds the M&A pipeline, which provides the earnings growth, which helps justify the high valuation. It's an entire ecosystem built around trust and permanence.
Okay, let's transition now to the stress test. How did this meticulously designed blueprint actually hold up when the macroeconomic environment turned against them in 2025?
Right. Before we look at the results, we should remind ourselves of those core financial targets that govern this whole decentralized empire.
The two big drivers. First, high EBITDA growth, targeting above 15% over a business cycle.
And second, extreme capital efficiency. That's measured by EBITDA divided by working capital, or EBITDA-WC, and it must be above 45%.
And that 45% target, that is the internal mechanism of control. It's the standard they hold every single one of their subsidiary managers accountable to, no matter what the market is doing.
Okay, now for the 2025 inflection point. The external environment deteriorated, and it did so rapidly. Fiscal year 2024 was strong. They had 3.0% organic growth. But 2025, conditions became cautious and sluggish.
And we saw that slowdown accelerate throughout the year, confirming the cyclical headwind. Organic sales were down -1% in the first quarter of 2025.
They worsened to -2% in Q2.
And by Q3 2025, the organic decline hit a significant -4.0%. And for you listening in the distribution business, a 4% organic decline is serious. It suggests customers are delaying non-essential maintenance or just drawing down their own existing parts inventories instead of buying new ones.
Okay. So, with all percent whole to fill in the core business, how did the group still manage to grow its total EBITDA by 7% year-over-year in that quarter? This is the ultimate proof of their model's design.
The answer is found in the power of diversification and very strategic management. The infrastructure segment, which we said is connected to those green transition tailwinds, was the designated growth engine.
And it delivered.
It absolutely delivered. In Q3, its revenue grew by a remarkable 21%. That was primarily driven by strong M&A contribution and just sustained demand for modernization and energy efficiency projects.
And what about its profitability?
Crucially, its EBITDA margin actually expanded to 14.0%. So it showed not only growth, but increasing efficiency.
So infrastructure was accelerating, and that was counteracting the slowing industrial machinery markets. The industry segment must have been the one that absorbed all the cyclical pain, right?
Absolutely. The industry segment focused on traditional manufacturing and tools. It bore the full brunt of the slowdown. It saw its Q3 revenue fall by 2%, and its margin compressed a little, down to 13.4%.
So end markets like automotive, metal fabrication, mining, they were clearly weak.
Very weak. But the key takeaway from it was that the growth and the high margin profile of the infrastructure segment protected the overall group result. It proves that the diversification strategy worked perfectly when it was put to the test.
And this required a very specific response from management. We can call it their counter-cyclical playbook. They didn't panic. They executed this combined strategy of offense and defense.
Their operational defense was textbook. They implemented aggressive cost adjustments across all the operating companies to protect profitability against that -4% organic sales headwind.
And in a decentralized company, that means the local managers are the ones incentivized to cut non-essential spending, optimize their staffing, and quickly adjust inventory levels to prevent capital from getting tied up.
Precisely. And then came their strategic offense. They decided to double down on M&A, using the downturn as an opportunity.
They stepped hard on the accelerator pedal.
They really did. Management acquired 6 companies in just the first 9 months of 2025. That added approximately 300 million Swedish kroner in annual revenue.
And that acquisition pace is significantly faster than they achieved during the prior, stronger fiscal year.
Right. The logic is simple. When the economy slows down, smaller family-owned businesses often feel the pinch. They become more willing to sell. And management has the dry powder on the balance sheet to move quickly.
And the outcome of that coordinated strategy is the 7% total EBITDA growth in Q3 2025. Achieved precisely when the organic environment was at its most challenging. I mean, that demonstrates the profound resilience of the model.
And we can actually verify the operational health of this whole decentralized system by looking at what we can call the red flag metric, capital efficiency, that EBITDA over WC number. This is the absolute litmus test of their governance model.
Because if the subsidiaries were panicking, you would expect to see working capital ballooning, right? Managers would start hoarding inventory, and collecting payments from customers would slow down as they try to keep them happy.
That is the textbook panic response. When your revenue shrinks, the first natural reaction is to mismanage your balance sheet to protect the income statement. And that leads to a collapse in capital efficiency.
But the exact opposite happened here.
The exact opposite. Momentum's capital efficiency remained, quote, rock solid at between 58 and 59%. That is vastly exceeding their minimum 45% target.
So why does maintaining 58% efficiency matter so much in this context?
It proves that the governance by numbers model is effective under stress. The subsidiary managers are successfully managing their working capital, they're meticulously optimizing inventory to prevent obsolescence, and they're aggressively managing accounts receivable to make sure they get paid on time.
Exactly as they're incentivized to do.
Exactly as they're incentivized by the group's performance metrics. And this discipline, it preserves vital cash flow for the parent company, which in turn allows the parent company to fund that accelerated M&A pipeline. The whole cycle depends on the subsidiary's ability to maintain that efficiency, and 58% confirms they passed the stress test with flying colors.
Okay, so we've established that Momentum Group's model is robust, it's efficient, and it has now been stress tested. But now we have to confront the market's perception of quality, because this leads us straight to the central paradox of their valuation.
Right, and to do that, We have to benchmark them against the best-in-class peer in the Nordics. And that company is the Lagercrantz Group.
Lagercrantz is the perfect reference point.
It is. They share an identical, decentralized buy-and-develop structure and the exact same core financial targets. For all intents and purposes, they are the benchmark for a mature, highly profitable compounder in this specific Nordic niche.
So let's look at the quality comparison, because the numbers are they're quite striking, and they really challenge this premium valuation thesis.
We have to look first at the ultimate measure of quality, which is profitability. Momentum Group's rolling 12-month EBITDA margin stands at 10.9%.
Which is good.
But it significantly lags Lagercrantz. Their margin is a stellar 17.7%. That is a 6.8 percentage point gap in profitability.
6.8%, that's a huge difference.
It's massive. And even in capital efficiency, the one metric Momentum Group excels at with 58%, the one that's so crucial to their model, they still lag the benchmark.
Lagercrantz is even more capital efficient.
They're running at a remarkable 75% EBITDA over working capital.
Wow. Okay, so by every measurable quality metric, profitability, capital efficiency, maturity, momentum is demonstrably the inferior peer.
That's what the data says. And yet, here is the valuation disconnect. Momentum Group's rolling 12-month EV to EBITDA multiple is currently sitting at about 25.9x.
26 times.
And the market is assigning Momentum the exact same premium multiple as its superior quality peer, Lagercrantz, which trades at about 25.2x.
That is the paradox in bold. Why is the market willing to price the stock of the B student the same as the A student? What astronomical expectations must be baked into that 26x multiple for it to be even remotely justifiable?
The market is fundamentally pricing in two very key optimistic scenarios, and both of them have to execute flawlessly for this to make sense.
What's the first one?
The first is pure multiple arbitrage. The thesis assumes Momentum can continue to buy earnings cheaply. Analyst assumptions hover around them acquiring companies at 6 to 8 times EBITDA.
Okay, so they buy at 8x.
Right. And the moment those earnings land on Momentum's consolidated balance sheet, the market instantly revalues them at 26 times EBITDA.
So this basically means Momentum Group is acting as a perpetual, high-efficiency financial machine. They're systematically buying assets for, what, 30 cents on the dollar, and immediately selling them to the public market for $1.
And as long as they can maintain a deep, cheap M&A pipeline, that arbitrage continues to generate massive shareholder value. And that helps justify the high multiple.
Okay, that's one. What's the second optimistic scenario?
The second is flawless margin expansion. The market has to believe that the current 10.9% margin is purely temporary.
A function of their younger age, maybe, or the cyclical pressure on the industry segment.
Right. And the market has to expect that those internal improvement programs we talked about, the business school, the sales school, will successfully professionalize all the subsidiaries they buy, and that the margin will significantly expand toward that 15 to 17% peer level.
So the valuation assumes that operational excellence will structurally close that 6.8 percentage point gap over time.
It has to. And this is where the debate gets really intense. Because if that M&A pipeline dries up, or if that margin expansion stalls, the entire valuation thesis just collapses.
The market will demand to know why a 10.9% margin distribution business should be trading at 26 times earnings.
Exactly.
And speaking of internal execution and market perception, we did identify a critical strategic weakness here. It kind of flies in the face of this narrative of operational excellence, and that's the undeveloped digital narrative.
Right. We noted earlier that digitalization is an existential risk, with 28% of B2B sales already moving online.
Yeah.
But Momentum's public commentary, it focuses very heavily on those internal tools, the business school, optimizing their supply chain, etc. And those are crucial for cost control. But they're all internally focused.
They aren't really talking about winning the customer experience war.
Exactly. You can contrast this with their competitors, like a company called A.O. Johansson. They actively market their customer-facing digital tools. Sophisticated 247 access apps, detailed logistics tracking, integration with their customers' own ERP systems. They market that as a primary competitive moat.
And Momentum's relative quietness on their customer-facing digital strategy, it suggests a potential vulnerability.
It does. Because if customers start to prioritize the convenience of a best-in-class digital platform, then Momentum's much-touted technical moat, that reliance on specialized in-person advice, could start to erode pretty quickly.
So that silence is a genuine worry for a company that is priced for perfection. All right, let's wrap this up by analyzing their financial capacity to continue this compounding strategy. Because they have an exceptional execution record, they have virtually achieved their stated long-term goal.
Which was to double their EBITDA to 340 million Swedish kroner by the end of fiscal year 2026.
And they are drastically ahead of schedule.
Massively. As of the Q3 2025 results, their rolling 12-month EBITDA already stands at 333 million kroner. They've hit their 5-year target in under 3 years. That kind of execution record gives management enormous leeway and a ton of market credibility.
And that operational prowess, it translates into powerful cash generation, which is key to funding all the M&A. They generated 323 million kroner in operating cash flow in fiscal 2024.
And that operating cash flow easily covers their sustainable dividend policy, which targets about a 30% payout ratio, and it funds a base level of M&A.
But to execute the accelerated counter-cyclical M&A that we saw in 2025, they had to leverage their balance sheet strategically.
They did. This is where you can really see management using debt as a weapon. Their leverage ratio, that's net loan liability divided by rolling 12-month EBITDA, it increased significantly in 2025.
And this was a deliberate strategic move.
Absolutely. They increased their leverage from a very conservative 0.78x in fiscal 24 to 1.42x as of Q3 2025.
Yeah.
This rising leverage is management signaling their confidence. They are deploying the balance sheet aggressively to acquire assets while the market is slightly depressed.
They're essentially borrowing against future earnings at a lower cost than their equity valuation.
That's the play. And crucially, for you listening, even at 1.42x leverage, they were still significantly under-levered compared to their best-in-class peers.
Like Lagercrantz.
Like Lagercrantz, for instance, which typically runs closer to 2.0x leverage.
So that is the key dry powder insight for the listener.
It is. Momentum has substantial untapped debt capacity remaining. Conservatively, they could probably raise an additional 300 to 500 million kroner in debt before they even reach the 2.0x level of their peer group.
Which means the M&A engine will not stall due to capital constraints anytime soon.
You will not.
And the acquisition pipeline itself, according to management, is flourishing, which helps de-risk that multiple arbitrage thesis.
The management commentary is explicitly bullish. The CEO, Ulf Lilius, noted an increase in inflow of new M&A opportunities, and he confirmed that acquisition valuations remain fairly stable.
So that confirms that the cultural moat is holding. Sellers still view Momentum as the preferred stable long-term buyer.
Which allows them to continue buying earnings cheaply even while interest rates are elevated.
Okay, finally, we need a reality check. When a company is this highly valued, we absolutely must consider the bear case, the key risks that could derail this stellar narrative.
And the primary risk remains M&A execution risk. They're moving at a highly aggressive pace. 6 deals in 9 months is a lot.
It is.
If they fail to integrate the cultures or the systems of these new subsidiaries, or if they're forced to start paying inflated multiples, say 10x or 12x EBITDA because of rising competition for targets, that instantly destroys the multiple arbitrage thesis. The entire financial magic trick relies on buying cheap and being valued high. If the buy-in multiple rises too much, the math breaks down.
Then there is the existential threat to the valuation itself, that structural margin question.
The structural margin gap risk is paramount. What if that 10.9% margin is not temporary? What if it's a permanent structural ceiling?
Because of their business mix.
Exactly. The nature of their business is industrial distribution and maintenance services. Lagercrantz, on the other hand, often focuses on proprietary niche technology companies that inherently command higher gross and EBITDA margins.
So if Momentum's business mix fundamentally prevents them from ever reaching that 15% plus margin level, then the market's current valuation, which is based on the expectation of margin expansion, is fundamentally unsustainable.
Correct. And finally, there's just the simple fact of valuation risk.
At 26 times EBITDA.
The stock is priced for perfection. There's effectively zero margin for safety. Any stumble, a severely missed quarter, a significant slowdown in M&A activity, or any evidence of margin stagnation that proves the gap is permanent will trigger a severe market reaction and a stock derating. The model is robust, but the stock price demands flawless, accelerating execution.
That was a tremendous deep dive into the engineering behind Nordic compounding. We've shown exactly how a decentralized, MRO-focused industrial group can grow profits through sheer strategic maneuvering and capital deployment, even when its core organic sales are shrinking.
And to recap the most crucial elements for you, the learner. Momentum Group has a high-quality, stress-tested business model. It's defined by decentralized operational efficiency, proven by that rock-solid 58% EBITDA over working capital figure in the face of macro weakness,
And they successfully deployed a countercyclical M&A strategy.
fueled by substantial balance sheet capacity and long-term structural tailwinds, particularly that green transition within the infrastructure segment.
So for you, if you're tracking this company, it means monitoring two immediate crucial milestones. First, does that negative organic growth, which hit -4% in Q3 2025, does it stabilize and begin to turn positive as the overall economy improves?
And second, and this is more important for the valuation, does the rolling 12-month EBITDA margin of 10.9% start to visibly expand toward that 12% level or higher?
But the final provocative thought really rests on the fundamental debate we raised earlier.
It does. The entire investment narrative and that 26x premium valuation, it all hinges on that 6.8 percentage point margin gap between Momentum at 10.9% and Lagerkrantz at 17.7%.
So you must decide.
Is this margin gap a temporary growth opportunity that Momentum will close through internal professionalization, finally justifying its high valuation? Or is it a permanent structural ceiling imposed by the difference between operating in essential but lower margin industrial distribution services versus owning proprietary industrial technology?
That decision right there determines the long-term viability of that premium price tag.